Hello, everyone. Welcome to the Capital Intelligence channel. Let's get right into it. Today, we're bringing you a highly focused explainer built specifically for those of you who are serious about finance and investing. We're going to unpack the ultimate leading indicator of market intent. And honestly, it starts with a pretty hard truth. If you're only looking at price, well, you're looking at the past. Price just tells you where the market has been, but volume tells you exactly where it's going. So think about it like this. Relying solely on price creates a massive, and I mean massive, blind spot. A lot of industry veterans actually call this trading in the land of the blind. And why is that? Because without volume, you literally cannot see the underlying structural imbalances of supply and demand. You're left completely vulnerable to sudden market dislocations, manipulated price action, and those brutal reversals that seem to come completely out of nowhere. But here's the kicker. They were actually telegraphed well in advance if you just knew what to look for. Okay, let's dive into our roadmap for this explainer. First, we'll decode the secret language of volume. Then, we'll track institutional footprints, break down the volume reversal methodology, look at broad market context, and finally, see how this all ties into predicting actual market crashes. All right, kicking things off with Section 1, the secret language of volume, and why price alone just isn't enough. The absolute fundamental law of technical analysis is simple, but it's profound. Volume precedes price. Think of it as the raw energy, the actual fuel that's required for any sustained market move. To really wrap our heads around this, we need to completely reframe how we think and starkly contrast price with volume. You see, a closing price is really just a fleeting moment in time. It's a temporary, surface-level agreement between a single buyer and a single seller. That's exactly why it's a lagging indicator. Volume, on the other hand, represents the total number of shares or contracts that actually changed hands. It measures the true financial commitment behind that agreement. It is the leading indicator of intent. Moving right along to Section 2, Institutional Footprints and Market Psychology. This is all about tracking the so-called smart money. Now, what's really interesting about this is that large-scale traders, the big market makers, they simply can't hide what they're doing. They leave unavoidable footprints. When they move massive institutional amounts of capital, they leave these footprints in the form of significant volume clusters. And by analyzing these volume profiles, we can basically see right through the random deceptive fluctuations of daily price noise. Let's break this down. When volume expands on up bars and contracts on down bars, the smart money is in accumulation mode, so you can expect a new trend to start. Now, if volume expands on down bars, that's distribution. They're selling off their positions into retail demand, which means trend termination is probably imminent. Extreme volume spikes right at the top or bottom, those signal exhaustion and an immediate reversal. And low volume? Well, that just means indecision. Basically, stay away until the standoff breaks. And that brings us to Section 3, which introduces a real tactical solution for serious investors, the volume reversal methodology, which is Mark Leibovit's proprietary tool. This methodology was developed by the legendary technical analyst Mark Leibovit, who, by the way, was ranked the #1 U.S. market timer. And the cool thing is, this wasn't cooked up in some academic lab. It was forged in the actual trenches of the Chicago Board Options Exchange back in 1979, where Leibovit was a market maker observing volume and liquidity in real time. So what exactly is the volume reversal, or VR? Well, it's a proprietary technical indicator that takes these super complex volume patterns and distills them into crystal clear, actionable timing signals right on your chart. It's specifically designed to signal high probability turning points by spotting sudden binary shifts in volume-driven momentum. So the crucial point to understand here is that these signals are completely mutually exclusive. You know how traditional indicators like moving average crossovers can lag and give you these frustratingly ambiguous readings? Not this. A single bar literally cannot generate both a positive and a negative VR. A positive VR happens when volume expands on upward price action. That signals aggressive accumulation, and you'll see it plotted below the bar. On the flip side, a negative VR happens when volume expands on downward action, which signals an institutional exit. That one gets plotted above the bar. It gives you immediate, undeniable clarity. I really want to emphasize the number 30 here. This specific VR methodology has performed consistently for over 30 years across all time frames. Because the math behind it is so rigorous, it's actually been fully integrated into professional trading platforms like Metastock as a dedicated plugin. This means traders can run automated mechanical scans to just instantly identify any securities that are generating these reversal signals. Pretty powerful stuff.
Okay, let's shift gears into Section 4, Indicators for Broad Market Context. Let's talk about reading the market's overall health. Listen, before any serious investor allocates capital to an individual stock, they absolutely must evaluate the macro volume flow of the entire financial system. You've got to know the overall health of the market before you go picking specific battles, right? And we do this by running through some critical tactical overlays. The cumulative volume index, for example, confirms if index breakouts are actually supported by broad volume. Then there's the ARMS index, or TRIN, which measures market breadth and spots those overbought or oversold extremes. And don't even get me started on stock-specific tools like on-balance volume or OBV. They are incredibly powerful. I mean, if a stock's price is making higher highs, but the OBV line is making lower highs, that's a massive red flag. It tells you the smart money is quietly distributing and cashing out, all while retail buyers are blindly pushing the price up. We've also got specialized broad market tools, like the interestingly named yo-yo indicator. This one is absolutely critical for warning retail traders about highly deceptive, really volatile topping or bottoming processes. What it does is look for rapid oscillations. We're talking extreme buying followed instantly by extreme selling. This reveals high-frequency institutional adjustments that, to the uninformed trader, just look like pure random market noise. And this brilliantly illustrates how stacking these indicators creates basically bulletproof risk management. Take the Chaikin money flow, or CMF, which measures accumulation and distribution over a 20-day period. If you get a negative volume reversal signal that generates right when the CMF is significantly below zero, boom. You have a mathematically confirmed, incredibly high conviction signal to either exit or short the position. Which brings us to our fifth and final section, predicting major market crashes. This is the ultimate test of volume analysis. Because really, the true test of any technical methodology is how it holds up during periods of extreme financial stress. As the source material makes super clear, market crashes rarely just drop out of the blue. They're actually the mathematical result of a cumulative erosion of liquidity, and that erosion is fully visible if you just know how to read the volume. Let's see how this builds across different historical market regimes. Right before the 1987 Black Monday crash, major indices were flying high, but internal volume was secretly deteriorating. The VR indicator actually generated specific negative signals before the collapse. Fast forward to 2000, and the dot-com peak showed massive volume exhaustion and blow-off tops. In 2008, negative VR patterns popped up systematically across the entire financial sector way before Lehman Brothers ever fell. And even in 2010, the flash crash was preceded by weeks of negative VR signals warning that smart money was exiting and creating a massive liquidity vacuum. To really anchor everything we've talked about today, I want you to keep this powerful psychological metaphor in your mind. Use volume like sonar. It allows the professional trader to cut straight through the surface noise. You see, high volume during a rapid price ascent, that represents tears of hope and greed, basically the retail fear of missing out, or FOMO. But high volume during a selling climax represents tears of joy and need. That's the exact moment where weak hands liquidate and institutional predators swoop in to buy at distressed prices. Truly understanding this dynamic allows for total emotional detachment. So, what does this all mean for you? It leaves us with the ultimate question for your own investing journey. Knowing that price is just a lagging indicator and that true market intent is hiding right there in the volume data, will you continue to rely solely on price and stay stuck in the land of the blind? Or are you finally ready to decode the secret language of the market? Thank you so much for joining us for this explainer, and we'll see you next time on Capital Intelligence.